Brad Williams, Frugal Finance, seasonal interest rate swap. A typical seasonal interest rate swap might have quarterly payments with payment each year being based on substantially larger notional principal. The paradigm here is a retailer with the quarterly flow of the year being larger to reflect the Christmas retail surge. Consider the following portfolio of bonds. Issue a semi-annual coupon forward rate note based on 6 months SOFR at par with a face value of $10 million with payment dates in May and November and a maturity of 7 years. Issue a semi-annual coupon fixed rate note based on 6 months SOFR at par with a face value of $10 million with payments in February and August and maturity of 7 years. Purchase a semi-annual 6.5% coupon bond at par with payment dates in February and August and a maturity of 7 years with a face value of $10 million. Issue an annual coupon 7-year fixed rate note based on 1 year SOFR with a face value of $20 million with each annual payment date in November. Purchase a 6.5% coupon bond at par with a face value of $20 million with each annual payment date in November and a maturity of 7 years. Together, these 6 bonds create a bond portfolio that is equivalent to a quarterly payment received fixed seasonal interest rate swap with a tenure of 7 years. The February, May, and August payment in the swap will be based on a notional principal of $10 million, while the November payment will be based on a notional principal of $30 million. At the initiation of the bond portfolio, the net cash flow is zero as the bond issuance offsets the bond purchase. The same is true when the bond matures. The repayment of principal on a bond that was issued is funded by the maturity of a bond that was purchased. Figure 21.5 shows the cash flows that would result from a single year of the bond portfolio. The cash flows have the same form as those of a swap. Exchange LIBOR was swapped. In a typical quarterly payment swap, the floating rate payments would normally be based on the 3-month SOFR. In our bond portfolio, they are based on 6 months SOFR for the first 4 bonds, and the additional November payment from bonds 5 and 6 is based on 1 year SOFR. Comparing the bond portfolios to a seasonal wrap, we see that the bond portfolio is cumbersome relative to the swap. The bond portfolio requires 6 bonds to replicate or almost replicate a swap that can be described fairly completely as received fixed at 6.5% quarterly with a notional principal of $10 million in February, May, and August, and with a notional principal of $30 million in November or a tenure of 7 years with floating payments based on 3-month SOFR. Notice that the bond portfolio is not exactly equivalent to the swap just described because the floating payments are based on either 6-month or 1 year SOFR in the bond portfolio and based on 3-month SOFR in the swap description. As a swap becomes slightly more complicated, the replicating bond portfolio quickly becomes extremely complicated. Constructing a bond portfolio that matches the swap cash flows and interest calculations exactly would be difficult. One would need the semi-annual payment FRNs in the portfolio to be based on the 3-month SOFR, which would be unusual. Alternatively, one might seek a quarterly payment FRN with payments based on 3-month SOFR. Either of these strategies would still leave the larger annual November payment, which would need to be based on 3-month SOFR as well. This kind of bond also would be rare. Even ignoring the problem with quarterly payments in the bond portfolio being based on non-quarterly SOFR, the bond portfolio is a cumbersome and costly way of securing the cash flow obligations that can be achieved inexpensively and easily through the swap directly. The operational efficiencies of this kind of swap relative to the bond portfolio illustrates one of the reasons for the swap market's stunning success. Brad Williams, Frugal Finance. More to come.